This isn't how I normally do this, but someone DM'd me on Instagram and asked me whether their property investment is a good investment. And obviously I had to pull up my Excel sheets and analyze this, but I also want to share the process with you, how I go about analyzing this, and what are the things that I usually see people missing when they do their own calculations. My wife bought a property last year, 1 bed, 1 bath for 970,000 Rand, a bond at prime minus 1.43%, rental income is 9,500 Rand, and the expenses on the property are 9,300 Rand. So in his mind, this property is cash flow positive, which means it's paying for itself. And doesn't this sound like the ideal scenario? We're actually just borrowing money from the bank to build up a property portfolio. But of course, there are a few additional things that we need to consider. Before we do that, if you want me to look at your request, please don't send me an Instagram DM, because now I've got a special form that you can submit your request through. Follow the link in my caption and please share as much detail as possible. And also, I don't only want to do property analysis. So if you've got any other questions about your personal finances, submit those questions to me and then I'll pick one. I'll try to do one per week or every second week and I'll share them on my channel. A few additional things that I think is important to consider when you analyze a property investment is the deposit that you pay, because obviously that is a cash outflow. And this is an opportunity cost because you could have invested that deposit somewhere else. The second thing is the tax that you'll pay on the rental profits. And this is a tricky one because depending on whether you hold this in your personal name or a company name, the tax rate might differ. In your personal capacity, it'll be included at your highest marginal tax bracket rate. In a company, it will be taxed at a flat rate. But in your personal capacity, you'll pay less capital gains tax when you sell the property eventually, and in a company, capital gains tax will be higher. Also, your entire bond payment is not tax deductible, only the portion that relates to interest. So as the years go on, the amount of interest that you pay actually decreases because the total principal on the bond decreases. Just something to consider. But I've drawn up a proper amortization table so that we've got the exact amounts of interest that is tax deductible per year. The next thing to consider is repairs and maintenance. As a rule of thumb, I'm using 1% of the property value, which depending on how new or how old the building is, of course, this could really vary. But I think this is a good rule of thumb. And in this case, the property is new, so it doesn't have repair and maintenance needs yet. But in 5 years' time, it might need some upgrades. So then these provisions per year will add up and actually be sufficient to make up for the upgrades in year 5. And also, I have seen everything when it comes to tenants and repairs and maintenance. So it's really hard to predict when you actually will need to fix something. Also consider rental agent fees. In this case, I'm going to assume there are no rental agent fees involved, just because he said that the rental income is 9,500 Rand, and I'm assuming that is after they've paid an agent or perhaps they're not using an agent. Then tenant vacancy and non-payments. Yes, you might have a tenant immediately in your property when you buy it, but when tenants change, there might be a period like 1 or 2 months that your property is not occupied, and also make provision for non-payments because the average non-payment rate for this bracket of rental income is 3.64%. And that added to the 1.07 vacancy rate in the Western Cape gives you 4.71%, which is your provision for non-payment and vacancy. The last thing to consider is insurance, because you'll have to take out insurance on the property, and also depending on your mortgage provider, they might require additional insurance. In this case, I'm going to assume a 300 Rand per month insurance. I'm going to take all of the information, put it into my Excel sheets, run some charts, and then show you the results. As always, I love a good Excel challenge. I like comparing property investments to stock market investments. So let's see how this turns out. So how am I analyzing this? In this Excel sheet, I'm going to look at the mortgage payments, assuming this is a 20-year mortgage, from year 0 to year 20. I'll also split the mortgage payments to identify the interest expense because this is tax deductible, and I'm using my amortization table to do that. And the next thing is the repairs and maintenance, which is a provision and assumed at 1% of the property value in this case. Then rates, taxes, and levies, which was provided by him, and I calculated this as a percentage of the property value, and then obviously this will increase with the property value every year. The next one is the insurance, which I've already mentioned. Then we get to the rental income amount, which was provided by him, and I'm assuming no rental agent fees are deducted from this. I'm projecting that rental increase by 5.96% per year, which is the average rental increase since 2012 per year in the Western Cape. And the provision for non-payment and vacancy is as I've explained before. Interestingly, this is also in line with roughly 1 month vacancy every second year. But of course, this also includes a provision for non-payment. Then we need to calculate the tax on the rental profit. So that will include your income and all of your outflows, but only the interest portion on your bond payments. In this case, I'm assuming it's in an individual's name and it's taxed at the highest marginal tax rate of 45%. You'll notice that the cash flows are negative for the first 8 years. So I'm going to assume the opportunity cost is you could have invested those negative cash flows into the stock market. Don't worry, I'm also going to analyze what if the property investor later also adds his positive cash flows into the stock market. It's going to get interesting. So then, of course, we need to consider the property value. I'm assuming the value of the property goes up by 5.99% every year, which is the average in the city of Cape Town since 2010. That would mean the property value goes from 970 when it's bought to 3.1 million in 20 years' time. I'm also adding a column to calculate the property net value, and this is really just to look at what if he sold the property in any given year and he had to pay back the outstanding mortgage on the property. This is the amount of cash they would get out before obviously paying an agent, but I'll add that later. Then we look at the cash flows. For the first few years, you'll notice the cash flows are negative, considering all of the costs and provisions and tax that we included. But when cash flow becomes positive in year 9, we're assuming he's investing the cash flows in the stock market. So then you would actually be building up a property portfolio and a stock market portfolio. So what return are we using on the stock market investments? In this case, I'm assuming it's invested in a Signia MSCI World ETF, which you will see returned 12.7% since 2008. That means his property and stock portfolio is worth 3.4 million in year 20 and 9.9 million in year 30. You'll notice there's 164,000 negative cash flow in year 0. This assumes a 10% deposit of 97,000. Also, bond costs of 35,000 and transfer and legal costs of 32,000. I assumed no transfer duty in this case because the value of the property is under the threshold. Now, let's try to compare what a pure stock market investment would have looked like. Of course, that would mean the negative cash flows in year 0, which is the deposit and the bond and the transfer costs, could have been invested in the stock market, but also for the first few years that this property was cash flow negative, those cash flows could have also been invested in the stock market. And the thinking here is we want to compare relevant cash flows, which means if this person is out of pocket for the first few years, we want to see what if they could have put that money, instead of putting it into the property, into a stock market portfolio. So this is really how we do the comparison. So assuming again the MSCI World returns I used earlier, this is how their stock market portfolio could have grown. In year 20, it would have been worth 2.3 million, and in year 30, 7.8 million. Of course, there is no guarantee around this, and I'm using a long-term average as long as possible so that we include market crashes and it gives us an average to try and forecast, but it's just an assumption. But now you're going to ask me, what about capital gains tax? Don't worry, I considered all of the capital gains tax implications and also the liquidation costs that would be involved with selling a property, such as agent fees. So again, across the board, we're using the same tax assumptions that this person is holding this property or the stocks in their individual capacity, which means capital gains are included at a 40% for a South African tax resident, and then taxed in the highest marginal bracket, which means there is an effective tax on capital gains of 18%, which is the highest effective tax rate possible on capital gains. On the sale of the property, I'm assuming an agent will take a 5% cut. Now that we've considered all of these exit costs, let's look at how these scenarios compare to each other. The property-only investment, which means the person only owns the property and they don't reinvest these cash flows, so they don't get exposure to the stock market, would be worth 2.7 million in their pocket. Remember, we're looking at if they sell this property. And then in 30 years' time, 4.7 million. That doesn't look too bad. But what if they could have put those negative cash flows that they had at the start of owning this property into the global stock market, like an MSCI World ETF? After 20 years, that portfolio could have been worth 1.9 million. And after 30 years, 6.4 million. So you'll notice that the value of the stock market investment, which by the way is also the exit value after assuming capital gains tax is paid, would overtake the value of the property in year 26 and then be worth 1.7 million more. But, and here is a big but, if the property investor then also invested in the stock market once their property turned cash flow positive, which was in year 9, what would their total portfolio, stocks and property, after considering selling costs and capital gains tax, what would it be worth? In year 20, 3 million, and in year 30, 8.7 million. So the combination of stocks and property is clearly the winner. And of course, a lot of people are going to say, yes, but he could have invested that additional cash flow into another property. And yes, that probably is the case. There are also many different things that he could have done with that cash, like could have bought some Bitcoin or some gold or whatever. And the comparisons could literally go on forever. If you want to compare it to any other specific scenario, please submit your request through the link in the caption and supply as much detail as possible so that I could potentially pick your question and feature it next time. And interestingly, what if the stock market scenario could have been invested in the S&P 500, which represents the US stock market? This Signia S&P 500 ETF shows an average return of 16.5% since 2017. So this is an 8-year average and perhaps not a long enough timeline. But also important to note that the total return in Rand is 16.5% and the US dollar return of the S&P 500 was 10.8%. So the difference between these two is actually due to the Rand depreciating against the dollar over the timeline that we're looking at. So this could look much different if the Rand doesn't continue to depreciate at this rate. But I wanted to run these numbers anyway to show you what that looked like. So if the stock portfolio increased with this value, which for two reasons I actually don't like. One, it's too short term of a timeline. And two, it's stock picking or market picking because I'm picking the US markets instead of using the global stock market, which I did before. The stock portfolio would have exceeded all the other scenarios by year 18 and would have been worth significantly more by year 30. Just something interesting to consider. And if you're very pro US stock markets, then it might be worthwhile for you to consider whether you're better off investing in the US stock markets. And something else to consider is that the interest rate used in this case is current interest rates, although we are on the higher end of an interest rate cycle and we're expecting interest rates to go down. But the current interest rates align pretty closely with the 22-year average prime interest rates that I got from the South African Reserve Bank's website. Please tell me what you learned in this video. And also, if these numbers and assumptions are realistic. I'd like to hear from some property owners if this is actually how you experience your incomes and your expenses and also the projections I've used. See you next time.